north-central region of the European Union has strong economies that represent a large portion of Europe. All four countries operate differently, but all offer opportunity for foreign investment. The region is uniquely arranged for tremendous opportunity and presents a great launching pad for global expansion. Each country's economy and financial environments present different challenges and benefits for firms looking to expand globally. The Netherlands and Germany have mixed economic systems, while the UK and Belgium have free market economies. A mixed economy allows a free market economy in consumer goods and business services, but the government imposes regulations even in those areas to protect its citizens. A free market economy is based on supply and demand with little or no government control. Belgium is often referred to as the capital of Europe. The Belgian capital of Brussels is home to the headquarters of the EU and NATO, as well as hundreds of international institutions, associations, and multinational corporations. The Belgian economy is inextricably tied to that of Europe. Belgium's central geographic location and highly developed transport network have helped develop a well-diversified economy with a broad mix of transport, services, manufacturing, and high tech. But the Belgian economy is currently in a state of uncertainty due to the collapse of the government in December 2018 and the effects of Brexit. Similar to Germany, there's a considerable gap between the richest and poorest citizens in Belgium. The top 20% of the population earn 4 times as much as the bottom 20%, and the bottom 60% of the population possess just 19% of the wealth. The Netherlands' economy flourishes through openness to global trade and investment and an independent judicial system that provides strong protection of property rights and fosters the rule of law. The efficient business framework is conducive to innovation and productivity growth. High domestic and external demand and still favorable financial conditions have stimulated private investment. Growth was estimated at 2.8% of GDP in 2018, and they are in the midst of a strong expansion. Brexit offers great opportunity for growth in the Dutch economy. Germany has the fourth largest economy following the United States, China, and Japan. The economy is expected to produce $4.2 trillion in 2019. Some say that Germany has been flourishing over the past 12 years as Chancellor Merkel has led the country to robust economic growth and record low unemployment rates. However, like mentioned before with Belgium, the real issue is inequality in terms of household wealth and real income. The bottom 60% of the population possess just 6.5% of the wealth in the country. This is the lowest figure in Europe. Comparing it to the US, who has the bottom 60% of the population possessing just 2.4% of the wealth, which is the lowest figure of any reporting country, Germans find that the same salary they made a few years ago now puts them below poverty level. This inequality is a major factor that needs to be addressed within the German economy. The UK has a fiercely independent, developed, and international trading economy that was at the forefront of the 19th century Industrial Revolution. Projected UK growth dips to 1.1% in 2019 and to strengthen only moderately to 1.6% in 2020. Slow growth this year reflects the drag on business investment from ongoing economic and political uncertainty relating to the outcome of the Brexit process. The UK serves as the largest market for the US with few barriers for countries to do business with. But these short-term risks are weighed to the downside due to the possibility of a more disorderly Brexit. The UK has one of the world's most efficient business and investment environments and will soon be open to expanded global trade relationships. In economically free societies, governments allow labor, capital, and goods to move freely and refrain from coercion or constraint of liberty beyond the extent necessary to protect and maintain liberty itself. The Index of Economic Freedom documents the positive relationship between economic freedom and a variety of positive social and economic goals. The UK has the 7th freest economy in the world, the 3rd among the 44 countries in Europe. Germany comes in as the 24th freest economy in the world, 14th in Europe. The Netherlands checks in as the 13th freest economy in the world, 5th ranked in Europe. All three are above the regional and world averages. Belgium has the 48th freest economy in the world and is 25th ranked in Europe. Its overall score is below the regional and world averages. It also is the only of the 4 countries whose economic freedom ranking has decreased due to sharp drops in judicial effectiveness, monetary freedom, that are not totally offset by improvements in fiscal health, tax burdens, and government spending. Belgium is among the world's top exporters and has little to no trade restrictions. It has quick procedures for setting up a new business, an entrepreneur friendly environment, and has an ideal location to reach out to the European consumer market. Due to its cultural diversity and its proximity to major production centers and sales markets, Belgium would be an ideal test market for new products for any U.S. firm. In its current state, the Netherlands economy is flourishing. With sensible banking regulations, efficient business frameworks conducive to innovation and productivity growth, and no restrictions on investments in most sectors, it allows for a great economic environment for companies. With high disposable incomes and a growing economy, it would be hard to deny marketing in the Netherlands as an economic opportunity. The United Kingdom is facing an intriguing opportunity while leaving the European Union. Due to their exit, they are diagnosing and prescribing internal changes to their economy and operation. As the United Kingdom is one of the largest markets for the US, marketers will continue to invest in this region. However, as the immediate negative effects of Brexit take hold, marketers may look for other markets. Belgium and the Netherlands are hoping they can be possible landing spots for any firms exiting the UK. The German economy has transparent and reasonable laws related to business. It is the largest European trading partner with the United States, and products with the Made in Germany seal stand for the highest quality worldwide. Germany also has the most international patents per 1 million inhabitants of anywhere in the world. The German market is open to entrepreneurial investment in practically all areas. Due to these attributes and its geographic location at the center of the EU, it is a cornerstone around which many U.S. firms seek to build their European and worldwide expansion strategies, and there's no reason why this should change anytime soon. The entire north-central region of the European Union has excellent infrastructure and connections with sea and inland ports, great airports, railways, and an extensive road network, as well as first-class telecommunication networks, highly qualified workers, competitive property prices for tax benefits, exceptional education, good health care, and a high standard of living. The region offers a strategic and valuable location for any firm looking to extend its global footprint. Germany, Belgium, and the Netherlands all operate their economies using the euro as their main form of currency. The United Kingdom, however, uses the British pound as their main form of currency. The euro exchange rate with the US dollar is 1 euro is $1.12 US. Over the last 10 years, the euro US exchange rate has ranged from $1.39 to $1.12, with an average of $1.37 US per 1 euro. The British pound exchange rate with the US dollar is 1 pound sterling equals $1.27 US. Over the last 10 years, the pound US exchange rate has ranged from $1.22 to $1.71, with an average of $1.31 US dollars per British pound. In terms of US firms' marketing activities, there will be a large effect on all four countries due to Brexit. Due to the stability and familiarity of the financial environments harbored by Germany, Belgium, and the Netherlands, the activity of U.S. firms can not only continue to be maintained, but may also increase with the opportunities presented by a European Union that does not include Britain. The Netherlands is acquiring companies that were once held in the United Kingdom and is targeting more. In 2017, Belgium acquired 40 of the 215 new U.S. foreign investment projects. Germany is the EU's most populous country and therefore also the largest market within the EU. If the UK makes a soft Brexit, they would keep access to the European single market and remain within the EU customs union, which would allow operations of US marketers to continue to run smoothly. However, with a hard Brexit, the UK would fully exit the single market and would significantly alter the way they operate with foreign investors. In relation to the UK, who is facing new frontiers in the face of Brexit, Germany, the Netherlands, and Belgium should only be able to reap the benefits of U.S. firms' marketing activities in relation to their financial environments within the region. Overall, this region of the European Union is strategically positioned as one of the best environments for firms to begin or continue their international expansion. With robust economies, trade-friendly regulations, and a huge consumer base, the region offers a unique mix that is unmatched globally.